Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsarthi. And starting, let wish you all our listeners a very happy 2026 and a great year ahead. And the topic for this podcast is also will investors increase their allocation to bonds in this year? Now, just the context is that looking back into 2025, the performance of various asset classes and what is the outlook for the whole market in 2026, and why would investors want to allocate, how would investors look at asset allocation in 2026, would be the context for this, and would bonds look to play a significant part in this asset allocation? And before we start, investors should understand that bonds carry liquidity risk, which is that buying and selling of bonds maybe have come at a cost. Interest rate risk, where the price of bonds can go up and down. And the third is that credit risk, where the bonds could also default on their payments when of principal. Investors should be aware of these risks before looking to invest in bonds. Now, coming back to the topic, now let's start with how asset classes have performed in 2025 calendar year. Now, starting with the equities, the large cap index, the Nifty index has given something like a 10% kind of returns, while outperformers have been gold, which is 70%, silver closer to 140%. So commodities have clearly outperformed. You have in the bond space, the 10-year government bond has given positive returns of about 7.5%. And the high yield, INR bonds high yield index, which tracks the performance of bonds in the AA to A category of bonds, high yield bond index has returned up to 9.75%. But in terms of spreads, high yield bond spreads have risen in the last 1 year, as RBI has cut the repo rate, and the rates have come down from 5.5% levels to closer to 5% levels. RBI, the high yield the high yield bonds have not really come down commensurate with the fall in 3-year government bond yields at the short end of the government bond yield curve, and this has risen in the this has resulted in the rise in spreads. To some extent, it also signifies that there is some, given that outflows, the dollar rupee has also weakened. The rupee has weakened by 4% against the US dollar in 2025. And that's to some extent telling the story on the liquidity as portfolio outflows as sucked out liquidity from the economy. And also, this is reflected in some kind of aversion towards risk in 2025, given all these situations. However, having said that, what is really what are the policymakers doing in terms of looking at this kind of stress? There's been a lot of things have been going on globally, right? There's been the latest the kidnap the taking of Venezuela by the US, and also many other geopolitical issues across the world. Then you have the tariff war, that tariffs that has been going on, the Cold War intensifying between US and China and Russia, and a lot of other geopolitical tensions have been really rocking markets globally as well, adding to volatility. In all this, and that's also one of the reasons why the dollar rupee has been volatile as well, and the dollar has really strengthened against the rupee in the last 1 year, and the rupee is trading at record lows as we speak. And also, a lot of money is going into gold and silver as more of a safe haven kind of a trade, rather than going into typically US treasuries or government bonds, purely because the markets believe that even government bond yields are not looking to really scale down in a hurry due to various reasons. In India, we have a peculiar situation where the inflation is well below RBI's target of 4%. The CPI index is less than 2% as we speak, and even the nominal inflation, which is which adds on which uh, uh, which adds on to the GDP of the country, that is really down. That's and the nominal GDP, which has been over the last many years have been well over double-digit levels, is down to closer to 8% kind of levels. There is a concern in this because a growth economy like India needs higher inflation and higher nominal GDP so that the fiscal deficit numbers of the government, which is looking to spend and pump prime the economy, looks even better. But if nominal GDP tends to stay down, then you have the fiscal deficit numbers looking to increase, and that could add pressure on external flows and many other factors as well. So so in such conditions, in that December policy, the Central Bank of India, RBI, Reserve Bank of India, has come out and said that clearly there is a case, given that inflation is at such low levels, we need to pump prime both growth and inflation. And so they've cut rates. They've also said that they will add liquidity through through purchase of bonds through open market operations. So they are looking to add close to 3 to 4 lakh crores of liquidity into the market. Also, they have done dollar US swaps on the foreign currency, USD INR swaps, where buy sell swaps, where they'll pump in immediate liquidity for future purchases, sales of dollars. So all this put together, the central bank is very keen that rates stay down and there is enough liquidity in the system. And even if there is portfolio outflows, the outflows can be negated by the fact that of the lasting liquidity infused by the RBI through bond purchases. So all this put together will keep rates low and liquidity reasonably well entrenched in the economy. The government too will look to, given all the external issues on tariffs and the issues with export data and trades and other factors, the government will look to boost internal consumption. And this budget coming in February will also see some kind of a consumption boost story rather than anything else. And given the consumption story in India, then you will have a lot of consumption boost will come from lending to the consumers by by NBFCs and banks, and especially the NBFCs that are reaching out to to a very large section of the population through technology and other aspects. So, given this, there will be a lot of consumption boost that is happening in the country, largely driven by loans to consumers, by especially, and these loans will come from very largely non-banking finance companies, and most of the non-banking finance companies that are reaching out to lend to borrowers through technology and to far and to borrowers not traditionally being even touched by banks or other traditional lenders are do issue are have balance sheet sizes which do not give them the AAA rating, while the fundamentals, they are able to take care of the fundamentals, improving the collection efficiency, making sure that they are liquid, and taking care of all the other aspects of a stronger balance sheet. So these companies are in the category where you call AA to triple B plus or triple B kind of categories, where these lenders are really gaining ground. They are either lending directly on their balance sheets or or doing off balance sheet co-lending, doing co-lending, which is enabling banks also to expand their books into such kind of borrowers. where NBFCs are able to reach, where they're able to reach out to those. So given these, and given the fact that this part of the lending space is looking to boom, then you have that these NBFCs would have to tap the bond markets for funding their lending and funding their growth. And the bond markets are going to be vibrant for these companies. We have seen many of these issuers come out and tap the market in large scales. 40 to closer to 30 to 50% of their liabilities would be from capital markets through issuances of bonds. And these bonds would look to be given to portfolios, investor portfolios, who are looking for an alternative, who are looking for one is higher returns, for higher returns in their portfolios, with a bit of with a good amount of stability in returns, and so that they can even if of any temporary volatility in other asset classes, this should negate that volatility. So, given all this, we do see that there will be a strong move by investors to allocate bonds to give more allocation to bonds in their investments, largely to provide stability to their investments, given the worry in growth and equity markets and the performance of and the fact that commodities are record highs, and also all the worries of global tariffs and other geopolitical issues. So everything put together, it does look like the bonds that are giving returns of say 9% to and upwards of 9% would definitely see more of a traction by investors in 2026. So the INR bonds is a platform that trades in these bonds. So investors can come and discover prices and then check all the information that they need to invest. And INR bonds is a SEBI registered stockbroker and also a bond platform provider. Thank you for listening in, and do follow us on all podcast channels.